Good morning, good morning. Good morning.
All the pens are out.
Why is your...
Excellent. I did tell you that we're going to bring up some of those issues.
Yes.
The next Dr. Kelly's going to come up. She's going to speak. You can
That
ask
was the
questions.
transfer, now we got a heart palpitation.
All right. I'm not, what we're going to do
We're gonna get some new evidence
fuse
on
neck
heart
stuff.
I
attack,
don't know how a guy that has a heart attack has a coronary...
But the thing is that do we want to talk? We can
No, we're not going to talk
later.
about it, we talk about it next week.
Right. Okay, fine.
But, you know, if you want to talk after, we can talk after.
Okay, fine. Okay, we're going to start now. This is the New York Fire Department Pension Fund Investment Meeting. Today is 5/16/2012. It is 10 minutes after 10. We are at the New York City Controller's Office, 1 Center Street, room 1117D, New York, New York. Could we have a roll call of trustees?
Roll call of trustees. Ms. Ron Levinson, here. Mr. Larry Schloss.
Present.
Ms. Janice Emery.
I have her proxy.
Mr. Steve Cassidy.
James Slevin has his proxy.
And Mr. James Levin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Mr. Straub has Mr. Kelly's proxy.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. Jake Lamanda.
Present.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
I have 24 votes and a quorum. We can start the meeting.
Okay, we'll start with the public agenda. Larry?
Okay, does everybody have their monthly performance package? In living color? Do you need it? Two? So I'm not going to walk you through the economic slides, but I guess in sum, the economy is slowly mending. This is what all the charts show. But everything in the economy is being overwhelmed by what's going on back in Europe, because it seems that we've had a couple of elections since we last met. We have a new president of France. They can't seem to get a government to work in Greece, so they're going to have another election in June. People are again talking about Greece getting blown out of the euro. We're back to bad. We're back to fair going to bad. Whereas all the numbers in here are clear sailing. So for the first quarter, calendar quarter, March, which is the numbers we're going to go through, everything's good. April is choppy, May is down. So we're kind of behind. This report, it's almost so far behind as to be interesting historical information, but it's just not where the markets are. And then you layer on top of that, the presidential election in the U.S., and I think it's safe to say that the numbers in here are probably the peak for the year, for the fiscal year. So, which is sort of not good to say, because, we got, 6 weeks left in the fiscal year. I just don't see it going up. And between these numbers in March and the April numbers sort of flat, which I'll show you in a second. So I guess I'm sort of pessimistic as to where we end up at June 30. We're kind of up 3%, as I'll show you in a second here. You could easily give the 3% back, even though we're doing a little bit of taking some risk off, but you can't take it off fast enough. Because again, we were kind of set up for generally clear skies. And if you then layer on top, the U.S. situation is we have the Bush tax reductions expiring at the end of the year, and you have the debt ceiling in the U.S., and you have this election. It's going to get very messy in the fall. So, and again, we're repositioning our asset allocation as we speak, which we're going to keep working on, which we'll talk about in a second. But overall, again, I think you're going to find the U.S. economy is trying and succeeding in getting better. Unemployment's going down. But again, it's really at the nice edge of slow growth, which is 2.5%, and consumer confidence is lagging, is up, but it's sort of lagging the reality of what's going on in Europe. And if the stock market were to go down 10%, I'm sure that would smack consumer confidence, would smack spending. Before you know it, we would be very happy again. And there is one slide I want you to look at, which I pointed out before, which they don't really like. In my crystal ball, I'll share my crystal ball with you all a little later. And that's on page 10. It says Architectural Billing Index, because it's the only chart here that's actually forward-looking. And again, this is construction of plants, office buildings, and things like that, because it's a year further out, because that's how long it takes between when you actually hire the architect and then start digging. And you can see it's sort of flat for the last 3 months, and hanging a little bit down. That's not good, because all these architectural billing things are stoppable before you get to construction. So if this thing goes below 50 in the next couple of months, it's going to be one of these very, very bright, flashing yellow lights at us. So if you flip ahead, get through those economic charts, which again are all pretty straightforward. The chart to really look at is page 24, which is a 10-year Treasury, which shows you people are starting to worry again. Forget the little head fake that we had in when it went up to almost 220. It's back below 180. In the below 180 is people that are freaked out, are starting to freak out again. And again, it's all, I would tell you, euro-based, because if you take Greece out of the euro, I'm sure there'll be unintended consequences. But you read the papers as much as I do. People are starting to pull their money out of the banks. It could just spiral out of control pretty quickly. That said, on page 25, again, as of March, because these are old numbers, spreads were narrowing. People were continuing to take some risk on in search of yield, which is really what the Fed wants to do. They want you to take more risk, and they want you to put the money in high yield bonds, investment grade things, as well as the equity markets. So if you were to jump all the way to page, I never find this in the right time. If you go to page 40, you'd see that in the first block of numbers, the stock market went up in March in the U.S. It went down a little bit internationally. Bonds backed up a little bit because, again, the money was coming into the equity markets. But if you go to the next page, 41, you can see it started to reverse in April, which we'll see those numbers next month, with the U.S. equity markets going down and the international markets also going down, and people going into quality bonds. This trend accelerated in May. Again, we're halfway through May, so you won't see those numbers till June or July. But there's definitely a trend that's caught up. So again, now if you were to go back to page 32, to my prior comments, you'll see that at the end of March we were at 8.3 billion, the highest ever. So congratulations. But again, it's coming down in April, and it'll probably come down in May. And I'm not quite sure what my crystal ball says about June yet. But so this could be the best meeting we have for the rest of the fiscal year. And if you look at it on a longer run basis, the next page, 33. Well, as I said, we're up about 3% fiscal year to date, but we're giving it back as we speak. So again, a lot more volatility the rest of the fiscal year. Big eyes on Europe. If you look at how we're set up on an asset allocation basis on page 36, and this is as of March 31, we were long U.S. equities and underallocated in Core Plus 5. And we had about 3% of cash. Since then, the cash has pretty much been invested. through a combination of benefits, payouts, as well as putting capital into Core Plus 5, hedge funds, opportunistic fixed income. And we subsequently decreased the U.S. equity exposure by about 1%. The market's probably taken an extra 0.5% off of that. We're finishing up some opportunistic fixed income documentation. Closed a couple of deals, actually, so that number should be, by the end of the fiscal year, probably marking through 3%. Yeah. So again, we're taking risk off and putting opportunity on.
Larry, just to stay with that for a moment.
Yep.
I want to be sure I understand page 37. So if I look at the top equity and fixed income line, it says actual versus policy 70.3 versus 65.5 for equities, and similarly plus 5% for fixed income. Going over to the adjusted policy, that's just the parking places, right?
It's adjusted for the parking places.
That piece. So
It takes your policy and adjusts it.
right. So the opportunistic investment that we've parked is going to reduce the equities from 65.5 to 62.8. But BAM could make the move for from S&P to core fixed income anytime it wants. And the core fixed income is, if you go down to the fixed income bucket, 16.5 versus 19.5. So just to be clear, 3% of this could be done by you all at any time since this policy was adopted almost a year ago.
That's right,
Okay.
yes. And is in process of being done.
Well,
So
I'm
for-
going to separate the process that's investing in opportunistic and hedge funds from a simple reallocation, which is a sell S&P index and buy Core 5. That's just a very straightforward reallocation.
It's straightforward. X transaction cost is straightforward, yes.
But
Yeah. We could easily get ourselves, we could make that trade. Yes.
Did you say that what would the transaction cost?
Well, there's some friction if it's selling something
Always.
and buying something, just, let's call it brokerage commissions, for lack of a better way to call it.
But we're selling mostly an index when we help
Yeah,
them.
yeah.
So what's taking that so much time? Why is that taking? Why are we a year later not invested for policy for that piece of it?
Well, I tell you that we're working on it, and by that I mean next month we're going to bring you something as a 0.5% in Core Plus 5. That's going to be funded out of equities. Part of the reason it looks as skewed as it does is the stock market's up 9% in the last 3 months. We've now given some of that back, so it's naturally shrinking. That actually went out of policy. We've been selling some. And it's sort of a longer range plan. We don't try to tweak it around every month to get in policy and out of policy. It's too much money and too much transaction breakage to do it. So we stay within the bands. This one has gotten out of the band. We have a plan, I guess, to get it inside the band within 3 months.
We should be there within 3 months.
Yeah. Everything else being equal. And again, one of the things that we're going to bring is private placements. So it's illiquid. So we're going to go from a liquid thing to an illiquid thing. We'll talk about that in the executive session next month when we bring it.
As part of the Core 5?
Yeah. But we'll talk about that when we bring it. So, hope that answered your question. But I understand what you're saying. Is there anything else to say on the allocation? I guess not. So if you go to page 42, you see again in the month of March we made another 1%. For 3 months we had a great 3 months, we're up 8%. And for the fiscal year we're up about 3%. And again, these might be the peak, so I'll tell you we're coming off these numbers. driven by equities, driven by Europe primarily, and some concerns about Asia, and so forth. But it's all, I would tell you, the vortex of the problem is now Europe. The rest of the managers, some beat it, some didn't on a monthly basis. Martin, you had a comment on it?
We do have a manager that we have some specifics that we'll discuss at the very beginning of the meeting.
SEMA.
And it happens to be one of the managers in red, so we can talk about it.
Okay. Nope. Let me take you with your mouth full. No. So if you got any other questions, that's sort of the report. Again, it's markets are going the wrong way. It's the simplest way to put things. So if there's no more questions on this, we can get to the next agenda item, which is bank loans. And that's Martin.
So, starts on page 63 of the book. There are some colored slides that help, but the bulk of the presentation will be those colored slides showing the explanatory new until the notices. But if you have any questions about not being able to read something or not understanding something, just keep up on this. So really, bank loans, you may recall we first came to the board back in 2008 when the world was turning upside down and there were great opportunities because of dislocations in the market. And at that time, we allowed the high-yield managers to invest in bank loans for the first time. Why was it the first time? Because the e-basket, and we didn't allow it. It wasn't legal. I'll get to that in a moment. But what are bank loans? They're effectively financial instruments representing a single claim on assets. The universe of bank loans is very similar to the universe of high yield. They're roughly the same size, about $1 trillion. It was a little bit higher within the last 2 years, but it's come down from probably the high 1.6 for the simple reason that Fed kept rates low. And during this historically low period, the bank loan issuers decided to refinance into the fixed rate market. Bank loans are mostly floating rate. I'll get to that also in a moment. And so they locked in for 5 or 10 years very historically low fixed rates. And so the bank loan universe has gone down to about $1 billion, which is still pretty large and on par with the high yield universe. But we generally don't have it in our portfolio. That's another item that we'll talk about. But before we start going into specifics about bank loans, let's make sure we know what we're talking about, because you can hear or read about different things about bank loans. In this presentation, we call them bank loans. On top of page 2, we talk about high-yield bank loans, ACA, aka also known as leverage loans. So you'll hear them referred to as leverage loans, you'll hear them referred to as bank loans, you'll hear them referred to as syndicated loans, you'll hear them referred to as loans. I'm not sure if Doug has any other names, but they're referred to as different things. We're talking about the same thing. Most importantly, in this presentation, we're talking about the performing loans. So just like high yield, our managers invest in investments that are not defaulted. They invest in effectively performing high yield securities. They may be distressed. They may be on the way up, being upgraded, but for the most part, we're talking about here performing loans. We'll get to what that means. We do have in our opportunistic fixed income portfolio, we do have investments that will invest in non-performing loans, meaning distressed loans. But that's not what we're here to talk about. But as far as, once we get the name straight, what we're talking about are basically loans that banks make to fund Barry's, for the most part, Barry's leverage buyouts, the LBOs. So what banks do is a company has an LBO, leverage buyout, they go to a bank, they get a loan, they typically will then either keep those loans on their books, which is these days more unlikely because of capital reasons, and more likely what they then do is package them to institutional investors. We have a chart on page 3, on the page numbers are on the bottom, page number on the top, something blacked out, but the page number on the bottom shows you where loans sit in the capital stack. So we broke it down into 3 major categories. We have loans, where the arrow is, we have bonds, which include high-yield bonds, and we have equity. And we invest, obviously, in equity. We have a significant equity portfolio, including private equity. We have bonds, including high-yield bonds, and many high-yield bonds are issued by the private equity deals, but some are not. They're just issued by companies that are rated below investment grade. And then we have loans. Loans go in the basket. We don't generally have them in the portfolio. We have a small amount in the portfolio, as we discussed in 2008. I'll get to in a moment. Generally, we don't have it in the portfolio because I know the law books are behind us right now. The law says that they're not legal securities, and the reason for that is primarily because the law hasn't caught up with the market. These are not technically securities. They don't have CUSIP numbers. They're effectively stacks of documents. They're loan documents. And so because they're generally considered private placements because they're not registered with the SEC, even though they have a higher standing in restructuring, meaning you get paid off potentially at 100 cents on the dollar, and we'll show some recovery rate charts later on, we're not allowed to invest in them, and they go in the basket. And historically, they weren't a good use of the basket. If you want private equity in the basket, if you want hedge funds in the basket, or if you want loans in the basket. And we'll talk about the returns that you get from loans also in a moment. But a very important part of what we have here is showing you that of the capital stack, the safest and most secure part of the capital stack, we don't invest in. And though that's what these things are. So let me go back to what they are and some key differentiators. A key differentiator between a high-yield bond and a bank loan is seniority. So in a restructuring, if something goes wrong, if there's a default, the bank loans get paid off first. So historically, the recovery rate was typically 70 to 90 cents, depending on the industry, depending on the issuer. It could be 100 cents on the dollar. High yield, typically was anywhere from 0 to 40, probably 20 to 40. There are subordinated bonds, there are senior bonds. It depends on the industry as well. So the recovery rate for high yield bonds is lower, so you got a lot more downside. The recovery rate for loans is much higher. There's also a much more significant difference in that we have a chart on page 4 that shows sort of some of the major differences between high-yield bonds and bank loans. And a major difference we listed first is the rate of interest. We talk about duration all the time, or maybe not all the time, but we talk about duration occasionally. And duration, there are 3 major risks in fixed income investing. We have credit risk, of course. Well, you get your money back. Effectively, you're making a loan. You're a creditor of the company, to the company. Will you get your interest payments and your money back at maturity? That's number 1. That's credit risk. Number 2 is duration risk, which is effectively the sensitivity to interest rates. When interest rates go up, the price of the bond goes down. The reason for that, you're now holding a bond with a low coupon rate when the market rate is high. And vice versa. When interest rates go down, you've seen a rally in our performance because interest rates have gone down, and therefore we have capital appreciation because the price of the bonds have gone up. That's measured by duration. Duration tells you how much the bond will go up or down. It's a function of interest rates. It's a function of maturity. But a very important feature, the differentiation between bank loans and high-yield bonds, is that the high-yield bonds typically have a bullet maturity, and they are issued similar to treasuries. They're 5 or 10-year bonds. They have a 6-month. Every 6 months you get your interest payment, and then at maturity you get your full maturity because they're high-yield companies. They generally don't mature. They generally roll over and get refinanced. But the reality is duration is important because if interest rates go up, the price of the bond will go down because of the duration. Now, the duration is lower than you have in treasury portfolios because you have such a higher coupon rate. The coupon rate lowers the duration because you're getting more of your money back as you collect that coupon. So while the duration is lower, it does have duration. Whereas bank loans are generally, not always, but for the vast majority of them, I'm talking about more than 90%, they're floating rate. What does that mean? It means that the bank loans that you buy that are out in the market have a rate of interest that changes. It changes based on the market. So it's usually a spread versus LIBOR. LIBOR right now is near 0. So most new issues of bank loans have LIBOR floors, meaning it's a 0 plus a spread. It will be 1% or 1.5% versus a spread. But importantly, it has, because of the floating rate, and depending on how often it resets, and generally it will reset every month, it will reset sooner, and it also can reset if a covenant is tripped. And bank loans have more covenants that protect the investor. So if something bad happens to the company or interest rates go up, because it has no duration, because the interest rate resets, it's pure credit. Moreover, when interest rates go up, you actually benefit because you're now resetting at a higher rate. Whereas if you're holding a high-yield bond or any other bond, a treasury bond, you're stuck with that bond with a low interest rate. So that's very important, a very important differentiation. So you're higher in the capital structure, you're senior, you're going to collect more in the event of something going wrong, and you have no duration. It's more pure credit risk. The other third risk, I mentioned there are several risks in bonds, would be spread risk, which is the risk that investors are seeking or avoiding bonds versus credit versus treasuries. And that ebbs and flows typically with the business cycle. Other differences between high yield and bank loans, you'll see priority, we talked about that senior. Bank loans get paid off first. There are first lien loans, and some loans are in fact secured by specific properties. So for instance, you can have loans issued by gaming companies, casino companies that are secured by specific properties. While high yield bonds also have covenants, the covenants of bank loans actually impact whether a default will happen, whether the creditors can force the company to make concessions, meaning a higher rate of interest, or the covenants themselves force a higher rate of interest. Amortization, I mentioned high yield bonds, it's typically 5 or 10 year issuance, and you have your 6 months, every 6 months you get your interest payment, and you get your money back in 10 years, typically it's refinanced. With bank loans, typically that principal payment gets reduced over time. So you have less risk if you buy $1 million bond that does get amortized over time, whereas high yield bonds. There are some bonds like that, but the vast majority there aren't. As far as the credit quality, it pretty much mirrors what you see in the high yield universe. There are mostly single B, double B. There are triple Cs, just like you have in the high yield market. And there are some investment grade, meaning triple B, but it's mostly single Bs and triple Bs. And callability. High yield bonds have callability. That's a very important function that's protected because the duration impact, prices can go above par. In fact, if interest rates go low enough, you can have high yield bonds that trade at 110, 120. And what that means is if the bond is called, because the high yield bonds have the ability to refinance, if the bond is called, you get called at par, and so there are covenants in the bond that say that the investor will get a premium for par in case the bond is called. With bank loans, generally, you don't have that. So those are some of the differences. But in short, you're first in line if something goes wrong, and you don't get impacted the way other bonds do if interest rates go up. So let's look at some of the characteristics and historical information about bank loans. So page 5, again, looking at the bottom page, the number, we show, going back a little over 10 years, the default rate. The number, the line that's a lighter color, because it's black and white, shows high yield bonds, and the darker color is loans, while loans do default. A default is not necessarily a bad thing, because again, you're in line to get paid first. And actually, our opportunistic managers, and we'll get to that later, are looking forward to that because there are some institutional investors such as insurance companies or other investors that have guidelines that say that they're required to sell if a company goes into default. And our bank loan managers and our opportunistic managers can take those bonds at that depressed low price simply because of the technical factor that investors are forced to sell. But the reality is that bank loans default less, and that's because there are covenants. And while you can trip covenants more easily with bank loans, there are very frequently negotiations between the issuer and the creditors to extend or change the covenants in exchange for a better deal, meaning higher interest rate. What about the recovery rate? So default's one thing, but if it goes into default, what do you get back? Until 2008, and you see in this chart on page 6, there was a significant downturn there. The historical rate of recovery was 70 to 90 cents on the dollar, and in many cases it was 100 cents on the dollar. You'll see that in the chart later. And high yield bonds are all over the map. It depends on the business cycle. It depends on whether you're in a senior bond. It depends on whether you're in a subordinated bond. But given that over, I believe it's 95% of the universe, investable universe, bank loans are in first lien bonds, you're getting paid first. So you don't have the duration, you get paid first, must not apply.
So Martin, I'm troubled by this chart a little bit. Question is, was 04 and 06, you referred to 100% recovery.
Oh, well, no, I said the recovery rate was higher. It wasn't 100%, it was near 90 or above 90,
Right.
depending on the
So the
industry.
question is that a bubble? And
If you extend this chart...
Can I finish my question?
Sure.
So because these are linked questions. So first is, there was the turn down in loans came in 2006. That was a strong economy.
Right.
So that's why the question about whether one almost dismisses that 04 through 06 number, because
Right.
maybe it was bubble conditions. And then, in fact, recovery rates went through high yield. And I just don't understand that. So can you just spend a minute on that?
Right. So let me address the first question first. If you extend the chart out further...
Martin, which chart are you on, just so?
We're looking at page 6.
Thanks.
The recovery rate. We have a price chart, and we also have this going back further. The recovery rates were actually higher further back you go, but we cut it off 2000. As far as, and so while there is a very significant business cycle sensitivity to recovery rates for high-yield bonds, and depends on the issuer, of course. If it's a cyclical company, it would get less in the downturn. But if it's a less cyclical company, you'll get more. And it also just depends on the companies and the assets. The reality is the historical recovery rate, if you go further back, is consistent with what we're seeing here. As far as the anomaly that you're seeing in 2008, that has a lot to do with...
2006 and 7.
Yeah, has a lot to do with the fact that credit underwriting at that time was not as robust. Investors were just looking to get in and put these securities, and the very next chart shows where they were going. They were going into CLOs, products that were leveraged, and they were the upper hand was with the issuers because the demand was so great for these. And so the covenants were either eliminated or tools.
Hence
I'm
my
sorry.
question.
Eliminated or?
Eliminated or more tools.
I would
Right.
speculate, since I have to go clean the data, but the word loans here versus high-yield bonds, I'll bet you have inside this data in 07 some second lien loans,
There are.
which are really high-yield bonds in disguise. And when the high-yield market and the bank market gets very, very frothy, like at the peak of a business cycle, you dress up a loan, you make it look like, you call it a second lien loan, it's really, it's not.
And
There's no
in-
collateral behind it. It's just a way of trying to fake the market into believing it's something other than a high-yield bond.
And in combination.
And I think that that's what this is. But we'll check the data, but that's my instinct, is having looked at this chart, because I can't recall when a recovery rate would be higher for high-yield bonds than loans.
My
It
guess
doesn't
would
make
be
any sense.
there's some anomaly in the data, either
It's
single or a couple
It has to do
issuers
with
or-
issue. This was the peak of the credit bubble back then, and so new bonds that were coming into, or bonds during the period of 04, 05, 06 were coming into the market with less protection for investors. Given that during that time, most of the investors, as you'll see on the chart before, subsequent to that, the CLOs, they were simply accepting of that. As the industry has become more institutionally friendly, those covenants have become stricter.
Well, but what I'm hearing is that the market changed, and so the data covers a lot of different types of loans.
I think these two words are,
And so I'm just, and statistically, I just look at this light gray line and say there are two means in this distribution.
So
That's just, so we should not be over-reliant on this historical information because it's overstating recovery rates.
And-
That's my point.
investors have learned from that, and presently the universe is 95% first lien loans.
we'll slice it. I think it's a good question, Roger. We'll slice it for you.
We can certainly get you the long-term data.
But just for our collective understanding.
Sure. So who owned these investments I was hinting before? And this is evolving and changing for the better. If you look at page 7, and I know this is black and white, so it doesn't come out as well, but the middle bar, which shows up as the darkest color here, was near 57% in 2007. It was even higher before that. It was near 2/3, and is now down to 38%. And that was CLOs. It's hard to tell what it refers to, but those were CLOs. CLOs are companies set up to borrow money and then invest in leveraged loans. That stands for collateralized loan obligation. And then they're tranched out and sold to investors. CLOs got a bad name during the financial crisis. And these days, there are fewer CLOs, number one, being issued. So the CLO market is being run down, as you see, it's now down to 38%. And as time goes on, it will be a smaller and smaller number. So several factors here. Number one, leverage is hard to find. And number two, investors are shying away from leverage. So you don't find CLOs with multiples of leverage attached to it. For instance, in our opportunistic fixed income, IBS, we allow no more than one turn of leverage in our senior loan portfolio. If at all, managers may not use leverage, and in some cases they haven't need to reach their IRR. But the more important thing is where's the money going? And that's the bottom piece of the chart. And those are the high yield funds, the bank loan funds, and when we did our search, and we'll talk more about that next month, while high yield we required, and we talked about that last month, we required a 5-year record, and obviously high yield goes back several decades. Bank loans for institutional investors on an unlevered leveraged loan basis had less of a record because it's relatively new that investors are seeking this, and Doug confirmed this for me. It's relatively new in the last several years, and investors are seeking this as a separate allocation. And this is actually good because most of the new issuance is now going to institutions such as pension funds on an unlevered basis. And so there's less unwinding, there's less need for leverage, and it's a healthier market. And because it's going to pension funds and investors who are investing on behalf of pension funds, they're demanding covenants and they're demanding protection that may have given way to that anomaly that we pointed out over here. I'm not sure if that has any comments on that. Effectively, the CLO money is going to, but on an unlevered basis, to complement a high yield portfolio. But there's no free lunch. And the next page shows the numbers of risk and return. On the left side, you have the Merrill Lynch High Yield Index that includes indices. On the right side, you have the Credit Suisse Loan Index. There are two main benchmarks here in the loan universe. There's the Credit Suisse Index, and there's the S&P LSTA. LSTA is the trade association. And the return you see is lower. The standard deviation, I will tell you, while you can maybe do anything you want with statistics, the reality is I would have you turn to page 12, just flip ahead to page 12, and it shows you prices. And let's go back 20 years. This is a 20-year chart, right? And with the brief exception of when we had the telecom downturn in 01-02, bank loans never priced as good below 90. I'm talking about performing loans, except for 08. So when you take it 08, and I realize you can cherry pick any number you want, but the reality is, with the exception of that downturn, which was not because there was anything necessarily wrong with the loans, but it was because of leveraged investors that were required to unwind their positions. So there were technical factors in the market that caused prices to decline. Prices have ranged from that, which is, by the way, why they were the ideal investment for CLOs. If you have an investment that doesn't change much in price, you can lever that up with some confidence that you won't get a margin call because the price is near par. And in fact, for most of the period, the price was very close to par. Unlike high-yield bonds, which is all over the place. I know it's hard to see this, but the darker line here reflects the bank loan price, and the slightly lighter line, or the line that goes all over the place, is the high-yield prices, and it's very, very sensitive to the economic cycle. And you'll see that prices can go over 100, and that's because of duration. Whereas because of duration, the price of bank loans generally won't go over 100. because there's zero duration, and you simply get a bigger coupon.
Put another way, at page 8, the
Page 8,
the
that's what I
volatility
did. The
number.
volatility number is in the low to mid single digits.
You going to say something?
I was going to
When you X,
say,
when you X
Martin,
out,
let him talk, would you?
no, I was going to say the 3-year period on page 8, the volatility number for bank loans is abnormally high because of that period that you just described.
so the volatility is significantly different from high yield. While high yield is generally about half the volatility of U.S. equities, for bank loans, the volatility is significantly less than high yield, and it is skewed by that 08 cycle that included technical factors where leveraged investors had to get out, and those levered investors are not backing because investors like pension funds are taking their risk. So when I said there's no free lunch, because you're higher in the capital structure, because you get a higher recovery rate, you're going to have a lower return. On the other hand, you're going to have less volatility. Next few pages in this, I know in black and white doesn't come out very well. We show 5, 10, 15-year numbers, but even after 15-year numbers, I know the last line, we show the top line. I'm looking at page 11 now. Let's go back 15 years. Capital market theory would say that equity over a 15-year period would have a higher return than high yield, which would then in turn have a higher return than bank loans. As it turns out, the bank loan return is in fact lower than high yield. The bank loan numbers at 515 annualized. High yield is 707. You can't see it there because of the color in black and white. But the last line, the third line there, for U.S. equities is actually lower than high yield. It's in the middle. So high yield has actually done better than U.S. equities in the last 15 years. And that's a function of what's going on in the markets at that time. But bank loans, in fact, do have a lower return than high yield, and you should expect that going forward. And we have a couple of charts that show that. So page 12, again, is a price chart for high yields, very sensitive to the business cycle, and also has duration embedded in there. And so when you see 02, you remember the 408, the last business cycle downturn was in 02, led by telecom, media, and other related instruments, and the prices of the high yield market were below 70 for a point, or were in the 70s. Whereas bank loans were just below 90, and you go back 20 years, that was the low. And the recovery rates, if you look at the recovery rates, if you skip, I'm sorry, we already had the recovery rates, and we don't show that, but it was 70 to 90 cents on the dollar, and depending on the industry, it was even 100 cents on the dollar. But I do mention that it comes at a price which is a lower return. Spreads on page 13 are shown. While it does look awfully close, it is slightly apples and oranges, and that's because the spread for the darker line, which is the loans, are based off of LIBOR, and the spreads for high yield is based off of treasuries. And the time that we ran this chart, which was as of February, it was a little less than 600 basis points. And we also have a chart in the book that Larry went through before that shows where high yield spreads are. So what about the yield? That's on the next page, page 14, and the yield to maturity, which is the top line for high yield, again, is much more volatile. When there's great distress in the market and the prices go down, inversely, the yield goes up. And so yields were actually approaching even over 20% in 08. And even back in September, when there was a slight panic in the market, the yields in high yield went above 10%. Whereas bank loans are much more steady because of the seniority and because of the knowledge that there are companies protecting you and that you're first in line, depending on the industry. But the yield that we're showing here is a current yield versus yield to maturity, and the reason we're showing you the current yield is because of the resets involved. That the yield to maturity number is actually an unknowable number given the resets involved in that. But the takeaway from this chart is that the yield that you're going to earn is going to be lower for bank loans, and that's the price for being senior in the capital structure. So I'm going to end with where do we own this presently in the portfolio.
Before we do, could I just ask a few more questions?
Sure.
On page 8, just to the point that you and Doug made about return and sensitivity, could you please add Sharpe ratios, because that's the only way you can compare it. And because you picked every period ending the same time, there's a huge end period sensitivity. Doug you mentioned this in a different context in the last meeting. So can we do rolling 3 or 5 years to see how they behave? Because this doesn't tell me at all how it behaves
So when we
through
do,
a cycle.
when we bring to you next month the bank loan search, which was done alongside the high yield search, we will have that information.
But I'm just asking at the benchmark level, because I'm almost nervous to jump right into a manager search conversation, because I don't think I understand this enough yet. Okay, so maybe you can just send around an email with a few more data points. That would be very helpful. And I guess then my open questions are, you said nothing about quality, you said nothing about the sector. In other words,
Right.
are there different industries that
Yes.
issue in high yield versus bank loan? What are we getting? We know how much it's worth, but we don't know what risk we are taking
Right.
on, and are they really different between high yield and bank loan? So open questions.
So I have the answer for that. And the answer is it really...
Well, hopefully it's something that I can look at and study, not just...
So we'll send you an email
Okay.
on that to give you the specifics, but to give you in general, the quality breakdown mimics what the high yield universe is.
So it's mostly
It's
single
double B,
B,
single B. So as of December 31st, it was 45% double B, and it was 33% single B. There was a few percent triple C, which is less than actually the high yield market, which is right around 10% or so. Right now, a little bit less.
It's
So how did that square with this being more senior? I mean, I'd have thought that it would be higher quality. That's what I
It
took
is.
away.
You should view it as, let's take it, and it's not the whole market, but let's just assume it's a buyout, for instance. So there's 3 pieces of a buyout capital structure. There's the senior, the subordinated, and the equity. We own the equity in private equity. We own the subordinated debt in high yield, and you're about to own what Mark's talking about is the senior. The high yield market is typically bonds, fixed maturity, single B, triple C. The bank debt on top of that is typically one grade better. So you're talking basically double B's and single B's, and then the junk is under it. Then you get into the way the structures are made, so you have the first call on all the cash flows, because you're senior. So if you look at the debt that we currently have, right, we have a bucket in governments, the best. We have a bucket in investment grade from AA, single A bond issuers. And then for some reason we skip down into high yield, single Bs. What we're missing is the stuff above the single Bs and below the single As. A lot of that.
Although that's a sweet spot for a lot of high yield managers, right? Because that's where credit
Some high yield
managers-
managers do this, some, but it's not. You're not getting the yield. You're getting comfort in the credit. So what you'll find is there's some high yield guys that when they get nervous, they'll move into senior loans, and when they're aggressive, they move out of senior loans into high yield. What we don't have is managers who just have the senior loans, who on occasion can search for yield and go get high yield bonds. So again, if you look at the spectrum of credit, we're missing on the large, to simplify, double Bs.
So let me ask my question a different way. So what you're saying then is this is inherently high yield companies, and it's just where in the capital structure do you play. So then my question is, could you show this relative to a triple B index? Because what I want to be sure is,
Sure.
I mean, when I look at page 8, and end period sensitivity notwithstanding, it's about half the returns of high yield. And I'm thinking, isn't that like a triple B benchmark? And so why are we going into high yield to get triple B returns? It's an open question. I don't know the answer.
One of the issues is duration. And also, I want to address the ratings as well.
So
The way-
duration, I think you overstated, Martin, because it's not as if floaters don't have duration.
They do, it depends
If
what,
you
it
had
depends when they
duration.
reset.
Even so, they have duration, and I don't think that, I'd like to see that.
But
I'd like to-
it's less than a year, and it's actually a few months of duration. So yes, it's not zero duration.
Well, so what's the final maturity on these loans?
Typically the same as high yield bonds.
So 10 years.
No, less.
Actually,
Five to
yes, and they
That's my
amortize.
question.
They're 5 to 7,
And they
state of maturity, and the high yield bonds are behind them at 10.
Sometimes 5.
So it's shorter, more senior, and floating.
So they're intermediate interest rates, intermediate maturity bonds, yes?
Yes.
As
But
opposed to
But they're floating rate.
Right. But people have gotten screwed thinking floating rate don't have duration,
But
right?
those were the ones that we're talking about. What you're referring to, I believe, is in '08 when you had weighted average lives, when people were looking at that in 6 subprime or in mortgages when they extended.
Well,
In
but
this
it's just-
case, they're not extending, they're being reset.
Well, if you got refinanced, you suddenly have a long bond. That's the very simple way to think about it.
Maturity.
The downside.
Maturity.
That's why the maturity matters.
Right. And because of the higher recovery rate, that should give you a leg up on the high yield investments.
Well, here's what I'm leading up to. You all are going to come back and ask for an allocation for this. And I'm not sure what it's competing against. I'm not sure yet whether it's a high yield surrogate, a triple B surrogate. What are we going to sell to buy this?
It's coming at a high yield.
But then I'm wondering if we're giving up too much return for
That's
this,
the question.
and therefore, that's why the triple B question.
And we'll be
So
working with.
We'll come back, because I think you asked ultimately a good question, which is, what's the spread? What's the risk and what's the spread? And conceptually, it's less risk than high yield and more return than investment grade. That's why it's a double B.
Right, so just show me that, right? Because the last
We'll
part you
try to
haven't
show you
shown.
that in a simple couple lines.
And I do want to go back to what I started saying before, which is how rating agencies look at rating needs. And the way they look at it, and this is part of the controversy of the ratings, is that it's the risk of the loss of any loss. So depending on the risk of loss, you will get a rating below AAA. So because there is a risk of loss of anything, they rate accordingly. But yeah, but they are high yield equivalent ratings.
They're non-investment grade. It's the
So-
senior-most piece of non-investment grade.
So as of
So it's
December
actually a very nice
31st,
place to be.
there were 5% in triple Bs, but the bulk of it was in single Bs and double Bs. There were about 12% that were not rated that were equivalent to single Bs and triple Cs. And as far as where they are in the capital stack, I mentioned first lien, second lien, and other bonds. 95% of the benchmark was in first lien and secured by specific assets versus high yield, which is either not or is, and generally is not. Now, there are high yield bonds that don't have any bank loans, that may not be part of an LBO or a leveraged buyout, and those bonds in the capital stack are the senior securities that get paid off first. But that's a big minority of high yield bonds.
Well, I mean, something as simple as a cable company, not an LBO, just a regular old cable company, or a satellite company. If the rating agencies don't like the credit, just as an operating company, they'll make it non-investment grade. This is the bank loan of a cable company that's levered. That's all. Doesn't have to be an LBO. And we'll get back to you with the splits on that as well.
Right, good. So, and we'll be working with the consultant on this and have some.
But again, if you look at go back to the basics, if you go back and look at our fixed income portfolio, there's a hole in our risk reward category that tends to be double B, and a little bit of what I'll call senior single B, because you don't really get very many high yield bonds that are double B, because there's this thing in front of them which is a senior loan. And again, since it's a floating rate, it's a good hedge against rates going up if that ever happens. And because rates have collapsed as much as they have, the issuers, the banks and the buyers have said, hey, you know what? It's nice that rates are low. We want a guaranteed minimum return, which is a floor.
Right, so they call that a LIBOR floor about
Yes.
1 to 1.5%.
1, 2, 3 in an LBO. So that floor is very, very useful to us. So we'll come back to you with some more information on senior loans. Any more questions?
So on one end of where this is in our portfolio, right now, as we talked, it's we allowed our managers back in 08, in November of 08, we implemented it in January of 09 to allow managers to have the capabilities up to 10% in bank loans. At that time, they did buy it, but because it's not in their benchmark, and once, as you saw the price chart, once the prices started going back up, you're now looking at yields and total returns that, number one, it's not in the benchmark, so it's higher attractive area. Number two, it's lower return than the high yield bonds. So they're generally reluctant to buy it, and the amount that we have in the portfolio right now is de minimis. The managers that typically will buy this will be the defensive managers, makes sense. The opportunistic or aggressive managers will buy it when events like happened in August occur. We also own this in our opportunistic portfolio, and we own it in two places. We own it in managers that buy distressed, and they're buying it just to trade because some investors are required by guidelines or law to sell when something goes into default or goes below a certain price, and they're required to sell. And so there are technical factors that make the prices attractive. And there's also the fact that the bank loans, while they're generally not the fulcrum security being the security that will ultimately own the equity and control of the company, they're above that, they can be. And so some of our distressed managers will own bank loans for that purpose as well. But they will be buying it, and this is the ideal thing, they will not own it in opportunistic, because I just mentioned that the return is lower. They will not own it until it's the perfect time to do it, and then they'll own it dynamically at the right time. Or at least that's the theory.
Some of our credit hedge funds do that.
Any other questions on bank loans? This is the next section, the basket clause. Larry?
No, the next section is,
Executive agenda?
yes.
Well, before we do that, I just want to note for the record that Bob Goldrich has joined the meeting from the mayor's office, joined it during the public session. And now we need a motion, I think, that there's not any more on this.
Motion to move into executive session.
Is there any objections? Hearing none, the motion carries. We are in executive session. Manager.